Hello and welcome to Guiding Assets, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and for this episode, I wanted to talk turkey, pun intended for our American listeners who celebrated Thanksgiving this past week, about what investors should be doing in this very erratic year. Depending on the region, the stocks are down 10 to 25% year to date, and it has definitely not been in a straight line. And with aggressive rate hikes around the world, bonds are also down mid-teens, significantly worse, of course, for long bonds. And if stocks and bonds end this year in the red, it'll only be the fourth time since 1929 that this has happened. So my question to answer today is, in a market where there's seemingly no place to hide, what should investors be focused on? So to tackle this, I'm joined by George Cipolloni. George co-manages the balanced income strategy at Penn Mutual Asset Management, which includes analysis and investment in dividend-paying common stocks and investment-grade and high-yield bonds. He's also a CFA charter holder. So welcome, George.
Thanks for having me, Michael.
So I want to start today, George, by talking about the role of liquidity in financial markets. We all know, of course, that stocks surge when the Fed is more dovish than expected or sell off when it surprises on the hawkish side. And one extreme example, you have Stanley Druckenmiller, who says that effectively earnings don't really even matter. It's liquidity that moves markets. So what do you think? How important is liquidity to stock valuations and their subsequent returns?
It's funny only because that quote really resonated with me, I think, a few years ago. And obviously, Stanley Druckenmiller is a brilliant investor. And when he said it, especially as a charter holder, I almost got offended at first because we spend so much time and a lot of our effort is done on the bottom up, examining companies, analyzing businesses, looking at income statements and balance sheets and free cash flow statements, that when I first heard that quote, again, it inflamed me a little bit. I'm like, wow, that's not true. But what we have seen over the past couple of decades, I think absolutely shows that liquidity is absolutely an important component. And I'll describe how we look at it. We view it as one of three components that actually drives securities, but it is incredibly important. And it's been a monumental period from a historical standpoint. So if you think about what's happened in terms of liquidity over the past few years, especially since COVID, if you just look at a chart of M2, money supply growth, if you just look at a chart of central bank balance sheets that have absolutely surged, and then you see the impact, there is an absolute direct correlation between what we saw in M2 growth and what we saw in central bank balance sheets and what we've seen in valuations. And so I'll just give you a couple of quick examples. So obviously, we know the balance sheets are up a ton. Central bank balance sheets were, depending on which one you look at, we're up about 70% across the board. The Fed balance sheet was up about 157% from $3.5 trillion to $9 trillion at peak. And M2 grew, it spiked up over 25% over COVID. And so pre-COVID, the NASDAQ price to sales ratio was 2.7 times. It peaked in February of 2021 at 4.6 times. And now it's back down to 2.7 times as M2 has gone down and as Fed balance sheet is tightening as we are going through QT now versus QE. S&P, same thing. Price to sales pre-COVID was 2 times. After the surge in money supply and liquidity went up to 3.14 times, which is over a 50% increase, obviously. And then now it's back down to 2.25 times. So those are some pretty specific examples of how liquidity certainly impacts valuations. Now, I will say, again, Mike, it's one of the components that we look at. When we analyze companies, we are looking at 3 levers. One is valuation. Number 2 is sales growth. Number 2 is margin. So the only thing I would add to or edit in terms of the Druckenmiller statement from a bottom-up stock and bond picker standpoint, I think he's right, generally speaking, from a broad, bigger picture macro markets level. Absolutely. I do think from an individual stock and bond picker standpoint, if you combine not only the liquidity function in valuation, but also a really good understanding of balance sheets and income statements and cash flow statements, then you can absolutely discern a little bit more and can add a lot of value using the 3-lever methodology that we like to use.
So I had a couple questions on that. So given that, are there certain types of companies that tend to benefit more from fiscal policy or monetary policy rather, get hurt more by the tightening? And the second part of that question is, Given the difficulty of accurately predicting these moves, how can investors apply the insight that liquidity is such a huge driver of returns? Because obviously you're not going to pick the top or bottom on these things, but I imagine it has something to do with, just being aware of where we are in the cycle is on the mark.
I think you're right, Michael. And so I think, again, we aren't going to nail every single Fed meeting correctly in terms of, and honestly, it really doesn't matter. So I think the perspective is important, long-term versus short-term. And so, again, if you're trying to trade meeting to meeting, I think that's problematic. I don't think anybody can really do that. Nobody can time the market as we hear over and over again. And so whether the Fed raises by 75 or 50 or 25, to me is less important versus the broad general direction of the tightening or the easing. And over time, yes, you can add a lot of value doing that. To your point, are there specific companies that benefited from it and are hurt by it? 100%. So again, tying in that edited Druckenmiller, kind of quote, if you do add in the earnings perspective, I do think one of the things that we saw obviously were that growth companies and nonprofitable tech companies for sure were the most impacted on the way up and on the way down. And so why is that? Well, it's because they didn't have a solid foundation of earnings to buffet the decline that we've seen. And so that's why, quite frankly, as a stock and bond picker, I think we're having a good time of it now because we focus so much on the underlying earnings. Again, that's your foundation. So going back to your point, yes, the non-profitable tech, which surged, and a lot of other funds, I won't name names, but a lot of other of those funds that focus on those growth companies did amazingly well for a short period of time. And then you saw them fizzle out just like they did during the tech bubble. And one of the main reasons why is because their primary driver of performance was that valuation, which was driven by M2, which was driven by Fed liquidity and central bank balance sheets. So yes, absolutely. I think it's important to know that, because once that liquidity goes out, once the tide goes out, you see what you really have there. And if you have operating losses and if you have just adjusted earnings based off of, stock-based comp, which really, again, it's not, good fundamental earnings, but if you have good fundamental growth, you have good fundamental operating margins and a good balance sheet, you will have some value. That's the value that we seek, and that's the value that ultimately is left there.
To Buffett's point, you see, once the tide goes out, you see who's been swimming naked.
Exactly. And there are a lot of, the next conversation might be, well, who's swimming naked? Well, there are a lot of companies that have been, swimming naked, a lot of investors that were invested in a way that they need to go get some swim trunks pretty quickly.
So, George, as I mentioned off the top, 2022 has challenged investors in both stocks and bonds, as bonds have not provided that historical sort of offset that they usually do. So I'm curious about two things. What do you think investors are overlooking in this current environment? And honestly, where can they hide?
Yep. So I think the big thing that everybody's overlooking, and this is a really big thing, like this isn't a little thing, and it happened and we saw it, but we're really kind of just in this hangover period. But number one is that zero interest rate policy created a massive bubble in bonds. And I think it's okay to acknowledge it. I mean, obviously we see it, and we see it in the performance of bonds today. But what we saw was absolutely an anomaly, something that you don't normally see. You don't normally see $18 trillion in negative yielding bonds globally. That's odd. And it's funny, I recall having conversations with one of my former co-PMs, and we were talking about the bond market, and he was really bullish on bonds, more bullish than I would have expected. And one of the reasons is that he said there was no bond mania, like there was on the stock side years ago, whether it's the tech bubble or, a bunch of different bubbles that we've seen on the stock side. And he said, we've never really seen that on the bond side recently. And I think back to that thought because I didn't think it, and it was pretty incredible that he thought it, and we had it. So we had this bond mania, we had this bond bubble. And so that's what I think is the big picture thing that we are seeing today that has burst. The Fed liquidity created a rising tide. It lifted every ship. It lifted stocks, it lifted bonds, it lifted non-profitable growth companies. And now that tide has gone out. So I know a lot of us are surprised at the magnitude of the decline in the bond market in terms of percentage performance. Even myself, we've been short duration for a while to kind of hide out, good balance sheets to hide out. But even our bonds are down too because they're all down. And again, I think it makes sense in hindsight, understanding that the correlation was together on the way up, high on the way up, and it's high on the way down now. And the second point I will say is that this environment is very different because it is an inflationary environment. We haven't had one in decades. And so either the people who've lived through the last one are not around anymore, or there are people like our age who just haven't experienced it yet. But if you do go back and look at a chart of correlations, you will see, going back decades, that over inflationary periods, bonds have not hedged stocks as they have over the last 10, 20, 30 years. So I think that's another important distinction. So of the two big points, it is, I think, number one, again, we were in a major bond bubble, and that's over. And number two, in inflationary periods, the correlations between stocks and bonds act a little differently than we normally expect.
What about earnings? I mean, we've seen sort of mediocre earnings. Depends on at what level you look at the S&P reporting. Good, bad, or indifferent.
Yeah.
What about that? What's under the surface there?
Yeah, so I think the biggest takeaway. So we look at hundreds of companies' earnings, whether we own the company or not. We think we can glean some type of information off of just about everybody's earnings, whether it's in the commentary or the numbers themselves. And so we do look at hundreds of companies. We look not only at the results, but at the reactions. And so every quarter is different, but I will say over the past year or two, the big takeaway is that the energy sector in particular is doing a lot of the heavy lifting from both a top line and a bottom line growth standpoint. And so if you exclude energy today, we've had our second straight quarter of down 4 to 5% in EPS growth and earnings growth. And so that, to us, that's a very important distinction to understand that, and to just know that everything's not bright and rosy, even though it hasn't been from a stock performance standpoint this year. Again, it's really been one sector that's kind of dominated from a growth standpoint. Outside of that, yes, there are pockets of strength. Areas that you may not even expect. Airlines and travel have been particularly strong relative to other segments of discretionary. Luxury companies have done a lot better than the lower end in terms of discretionary. Healthcare, which is an area where you really wouldn't think it could do that poorly, is doing terrible. Outside of pharma is holding up well. Healthcare service companies that sell into healthcare are having a horrible time with labor shortages and inflation. And we are seeing stocks down 30, 40, 50% on post earnings. Very different, absolutely very different times in that regard. So it's different sector by sector, company by company. Overall, we are seeing a broad deceleration. COVID spike in sales and earnings that part's over. And so we are seeing, tougher year-over-year comps and things like that. But it really is, and I hate, it's funny when we listen to interviews, and I hate when people say it, but this really is a stock and a bond picker's market. I think if you are skilled at financial ratio analysis, if you understand management strategy and the way to combine both the subjective analysis and including the objective analysis in the numbers, I think there really is a lot of value to add here today versus in years past when everything was just going up broadly.
So is there anywhere in particular or any sort of element that you're looking for as you look across the portfolio, and where are you seeing the opportunities?
Yep, absolutely. So I think in broad terms, because we don't speak about specific companies, but in broad terms, you can definitely hide. Bond investors can definitely hide in great balance sheets. There are, so the market doesn't really differentiate on the downside, just like sometimes on the upside it doesn't. But you can find some really, really great balance sheets, even in high yield, maybe issued by smaller companies and companies that have more cash than debt on the balance sheet. That's a great place to hide. Those companies will not have to refinance, which is a huge benefit in a rising rate environment. So, just conversely speaking, if you think about where we could get in trouble or where the downside might be, it's going to be, default rates will go up. I don't know where they are going to go, but they're going to go higher than zero, which is they've basically been close to zero over the last few years. They're going to go higher than that. Do they go to 5%? Do they go to 10%? I'm not sure. But what we've seen, or what I think we will see, is that we hear a lot about zombie companies in credit. I think the refinance game, the easy refinance game where these companies have stayed alive purely because they could refinance at lower rates, that's over for now. We have a 4 to 5% hurdle rate, and that's different than at any point over a very long period of time. And so I think that game's over. So unless you have sustainable earnings and a good balance sheet to support your credit or your bond, you're going to be in trouble, and there will be defaults. And we already are starting to see some cracks in the credit, on the credit side. On the stock side, yes, I think, again, if you focus on good margins, good sustainable margins, and there's companies that are out there, good return on capital, good balance sheets, those are all pockets. And I will say, so our three biggest winners were all small caps over this past reporting period, and, significant increases after earnings, unexpected, because the valuations in small caps versus large caps have been so low relative to history. There are additional pockets of value, I believe, in small cap stocks, especially of companies that have good balance sheets.
So cash is king.
People say it, and it's funny. Obviously, lots of people in the market have said it, but yes, I think cash on the balance sheet, I would just make that little. So at normally, yes, I love cash because of the flexibility that it gives us. But right now we are getting paid. We have a very low cash level. And because I would just add that little stipulation, cash on the balance sheets is absolutely king. And now you can get 4 and 5 and 6 and 7% yields for companies that have more cash than debt, that don't have to access the capital markets. And yeah, it's so refreshing to finally get paid again, where we were slugging it out for so long with, anemic yields. And I'm quite frankly thrilled that period is over now.
So what do you see then, George, as the downside from here?
Yep. I think ultimately, I don't know in terms of big picture levels. So I think if you think about the way the market's trading, the dollar has had a huge impact both on U.S. and international companies. And you can absolutely see the dollar swing back down, and then that could drive, honestly, a nice little rise in stocks. Yeah, absolutely. So I think more in terms of potential outcomes versus anything else. I think there will be some downside in credit. There will be some downside in companies that, again, do not have sustainable margins, do not have a good business model, that maybe came to market over the last few years with the hype that we've seen across the board in capital markets. I think there will be downside there. So it will be a much more mixed environment, so to speak. And you never know. Obviously, we have some pretty major headwinds ahead of us that we need to get through. I mean, there certainly is an outright hot war in the Ukraine with Russia. And we have economic wars starting up all over the place, not just between the U.S. and China now, or the U.S. and Russia now, but you're even starting to hear some frustration out of the European companies, which were our traditional allies, obviously, and they are getting a little frustrated as well. So I do think in terms of, so what I would say is that I never try to tie ourselves to a specific outcome, whether the market will be up or down or not. I try to think of potential outcomes and where the risk might be. And where the risk might be is that, again, each country is in their own trouble, whether it was the UK with their pensions, or whether it's Germany with natural gas and having enough fuel for the winter. Those types of scenarios and situations historically can lead to volatility. And so that's something I'm definitely keeping a very keen eye on, how those dire situations or desperate situations will hopefully resolve themselves. But if they don't, it could create more periods of volatility than we've had in a long time. Sure.
Well, George, we're coming to the end here. So we've got our kind of 2-point question at the end. So what was your first job in the industry? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
This is my favorite part of the show. I love it. I've listened to so many of these podcasts. You've had some incredible guests over time, and this is absolutely my favorite part of the show, and I think it adds so much value for the listener. So my first job in the industry. So I came from way outside of the industry. I grew up doing concrete work in my family's business. And I went to Drexel University and they had a co-op program. And my first job in the industry was working on the floor of the Philadelphia Stock Exchange for a firm called Susquehanna, which is an absolutely outstanding global trading firm. At the time, they were much smaller, of course, back in 1998. But yeah, they've grown and wow, they really did things the right way. So that job opened my eyes to so many different things, not just finance. I fell in love with the financial markets. I fell in love with the trading component, even though it's not a huge part of my job today, but just understanding markets. And it really gave me a great appreciation and understanding for behavior in markets and how they can impact your decision making. And so again, just being in an open pit on the floor of an exchange is an eye-opening experience. You learn so much about how markets move, why markets move, and about behavior. And it really was a foundational lesson for me that really helped me build upon over time my career and the direction of my career. And I found myself to be, you find out a lot just as much about yourself as you do about the markets, and you find out what kind of investor you want to be and what kind of job you'd want to have in the industry. And so those early positions are really important for people, and they leave a mark. The lessons that I've learned will carry with me forever. And again, a lot of the future journey and exploration really came from that first job, and I'm so grateful for it. So what would I tell myself? I think the biggest takeaway, I think, is enjoy the journey in the moment. I think we work so hard, as you know, Mike, and you work hard every day, and time just goes. And especially in this business, the years just fly by. And I think just enjoying the journey in the moment is really important. I try to do that more. Actually, today's my birthday. I'm 48 today. And you think back, to the coming into the industry as a young person, and gosh, it just goes by so fast. So just enjoy the journey in the moment, every moment, even the bad ones, especially the bad ones. Just understand the bad times don't last. The good times may not last either all the time, but just enjoy all the moments. And then if I had to give myself a piece of advice, it's don't ever speak, email, or communicate in anger. I've done that in the past. It's absolutely a terrible thing to do. I just think we all need to give ourselves time to take a step back, think about what you want to say, how the message will be received, and be sensitive to who you're speaking to and again, how that message is received. And the great quote from Maya Angelou, of course, is, I've learned that people will forget what you've said, people will forget what you did, but people will never forget how you made them feel. And that is absolutely true. And I know there's, some things that I've said in anger where people will never, ever forget that I said them that way. So I think I am a lot more sensitive to, again, how messages are delivered today than maybe I would deliver them as a younger person.
Well, hopefully, George, our listeners are feeling a little smarter now than they were at the beginning of our show today. Thanks so much for coming on, and happy birthday. It's funny, actually, my birthday was 3 days ago, same year of birth. So there we go. Happy birthday to us.
That's awesome. Happy birthday, Mike. Thank you so much for having me. You do a great job. Thank you.
I've been speaking today with George Cipolloni, Portfolio Manager at Penn Mutual Asset Management. I'm Mike Wallberg, and this has been Guiding Assets.